Welcome again to the morning session. Today is 2nd of January 2025, Thursday, and this is how the Sensex is trading today. It's just around 10:30 a.m. in the morning. After the first 1 hour of trading, Sensex has moved up today, and I took this opportunity to enter another trade. I sold a couple of call lots, 80,600. Two lots I sold, and as I can see, it is still further away. There's a good chance that Sensex would expire below the 80,600 levels, thereby earning me the entire profit. Now let's look at our current positions. And there you see, yesterday we were sitting around 950 or 1,000 rupees profit based on the previous two positions, 76,200 P and 81,000 C. And cumulatively, they have extended the profit to more than 2,000 today because there's been more decay in the premiums of both those strike prices overnight, and we are about 2 days or a day and a half away from expiry for Sensex. And if you look here, what I just mentioned, today morning we entered another trade. We sold a couple of lots of call, 80,600 CE for a price of 45 approximately. And now let's look at the current margin that has been utilized. There you see the current margin that is in use is 3.3 lakhs, which is very similar to the margin utilization yesterday, 3.07 lakhs. The reason, even after we sold a couple of more call lots, margin requirement hasn't increased drastically. That's because now we are in a balanced strangle position. We have sold a total of 4 put options in a single strike price 76,000 P, and we have sold 4 call options as well, 2 of them at a strike price of 80,600 and 2 more at a strike price of 81,000. That's how the overall strangle position looks like. The plan is we wait and hold on to this until we are very close to the expiry time, which is Friday, end of the day. I wanted to show you one more thing. As you see, I am trying to exit my far strike prices at a very low premium. Now, if you see, the thought is, if today Thursday with about 2 or 1.5 days left to expiry, if the far away strike price premiums reduce to a low value, whatever I'm trying to exit, 3.1 and 3.5, if I can do that, then I can obtain back all of that margin, whereby I can enter a near strike price somewhere nearby till outside of the expiry, and hope to make a larger profit by selling premiums of a higher value. So if we look, Sensex is inching on the higher side. We'll continue keeping a watch and come back sometime later in the day. Hello once again. We are at end of the day on Thursday, and let's look at what has happened in Sensex. We see that Sensex has gone up a lot. It is at 80,000 and it's gone up almost 2%. It's 1.8%. Let's see how we handle the open positions since the morning. So there you see it. What I did was, as Sensex went up around 11 o'clock, 11 a.m. in the morning, I sold another call, hoping that it would be range bound, or at the least if it did go up, it would come back. But that was not the case. So today was an exception. Let's see what the exception is, and let me bring up the daily chart to show you what I mean. So here's the daily chart, and you see the movement of Sensex since the month of November. And if you see, it started coming down in the month of December, the mid of December, and the 19th there's a huge gap down, a very big gap down of almost 2,000 points. And since then, all the way through yesterday, it was range bound within 79,500 on the upper side and 78,000 on the lower side. But the trend was broken today. It's a huge move. You see this green upside bar. It went up all the way from around 78, 600 to almost 80,000, and it has filled the gap. What the gap down was there earlier in December, that gap has been filled. So it's a break in trend, and this is contrary to our view that the market would not move a lot. And that's very important when you take a strangle position, and once the market moves against the view, then it will very quickly start accumulating very big losses, which is why it becomes necessary to take a corrective action. And though we did have an outlook, a particular outlook that it would be range bound, we also had an inbuilt protection mechanism. What we did, in other words, was to ensure strikes we take are very far away. They're not near to the strike price. Far away enough that even though there's a big move, it would still be nowhere near to the selected strike prices. The spot wouldn't reach our selected strike prices. That's the reason we took strike price that is 2000 points away from the current spot price. And that's how we selected 80,600. So even if Sensex did move 1.8%, the way it stands, it is still 700 points away from our strike price. Because of this, even though there's a big move, it went nowhere near the money. In fact, it is still out of the money, and that has given us some time to continue watching how the premium evolves with time today. And let's see how the premium has done for the 80,600C, which is the lowest of the two call lots that we have sold. It's a weekly call. So we entered sometime this morning around the 45 rupee mark, and then around 11 a.m. when I saw it went up, under the outlook that it will be range bound, it will come down quicker, I wanted to average out, and I sold it for 61. It did temporarily come back to mid 50s, and had it continued, it would have stayed in range bound just as we thought. But around the noon time, there has been big upside move. If you see between 12 and 12:30, right, within that half an hour, there's been a huge upside move. So this, what is the strike? 80,600 is the premium for that shot from 52 all the way till 130 plus within a short span of time. And later it did come down to 70s, and again I thought, let me watch out for a little bit more time. But then towards the end of the day, as the trading was going to come to close, it again went up and was trending some way towards the 100, which is like very much away from our average cost of 51. We were 3 lots total in the 80,600C. 3 lots were sold for an average of 51, and at some point it reached somewhere around 100, which is like it went twice that, or a loss of 15 to 30,500 rupees we had within this. And the Sensex also was hovering around 17,900, 80,000 mark, and to let it leave in the same state would have meant carrying a big overnight risk, which is not a good thing to do at all, because tomorrow morning there could be any gap up opening, or there could be a lot of volatility, and the strike, or the strike for the call, the premium for that would actually fluctuate a lot, go higher than this 100 is a possibility. And we're not one but 3 lots we sold, so that last whatever we have currently 1,300, 400 something, that would compound and may possibly run into 2,000, 3,000, and there's no limit to it, right? On the upside it could be as much as 5,000, 6,000 loss as well. So what we had to do was accept the reality, right? Now there is no more averaging, right? If the thought is like, could we have added more lots and averaged it out, the answer is no. It's a preference to not do it. See, tomorrow we do not know what will happen, but it's a very good possibility that there can be a gap up opening, and the strike of the call 80,600 is just 700 odd points away, which is like less than 1%. And today itself we had close to 2% up move inside a single day, and we're just talking about half of that. And it's very possible that sometime it could breach that tomorrow, or there could be a very big gap up opening itself, right? And this up move that happened today, which is filling the gap of the mid of December, it was unprecedented because there has been no other global change that happened. US market was muted, was flat, and in Indian markets it's supposedly, as per the news, there has been a lot of interest shown by investors, both in the individual stocks and also by mutual fund houses, because there has been a lot of downside in the market for the past many weeks, a few months, and quickly a lot of these large cap stocks which were down by 30%, 40%, even 50% from their all-time highs. So there was a renewed interest by all of the fund houses and retailers as well as a euphoria for the new year, an outlook for the new year, and a lot of people are predicting bullish January as well. So that is unprecedented from a global perspective. There's no other event, there's no specific event why it went up. It's more of a renewed interest. So that's why we have to be very cautious. If it has to move either side, up or down, it does not need a very specific reason. Right? A bunch of people, investors, or the traders who are participating in that day, and the combined sentiment, if it is strong enough, it will carry the overall index in that direction very much, right? So there is no control there, and that's the reason, given this reality, we did not want to take an additional risk of averaging it from now onwards. When we did averaging out earlier in the day, there was a reasoning. Our strike price was selected so far away that even if there's a big move of 2% also, right, even then we'll be safe. Right? The option would be out of the money. That was the reason why we averaged it around 11 a.m. But now there's a very high probability that it may be breached, and the call which we sold may become in the money, and it's not a good thing. It's not advised that we do any kind of averaging out. Now the second possibility with us was, don't have to average out, but can we just wait and watch further and see if there's a decrease in the price? So the answer is we did that, right? We did it throughout the day and middle of the day and towards the end of the day as well. And what we saw was there was hardly no down move, and the premium was just trading around 100 for most of the time. So it wouldn't make sense to think that tomorrow we have to wait and tomorrow it may come down. It may actually come down as well tomorrow, but even if there's a small chance that it can go against us, the option is very close to being in the money, then it's not a good thing to do. So this is where we draw the line. Risk management. And it's not good to have a lot of greed when you're saying that there is a potential loss you can accumulate. There's a loss, but it's fine. We accept there's a loss and we take an exit here itself. So the total loss has been, if you see the position that is closed, 80,600 CE. At some point of time, we had 3 lots sold for an average of 51, and we did exit them between 89, 98, 102, 3 different lots at 3 different prices for an average of something around 95, 96, and that meant that I have accumulated a total loss of almost 1,400 rupees within this one strike price on the upper side, on the CE side, and somehow on the put side 76,200 P, right? We had a total of 4 lots there, as we earlier discussed. So this 4 lots made a decent profit of 2,200. So that way we're still in some net profit. We are not into net loss as of today's standing. There's still some net profit that we are in because of the overall outlook that we had, the strangle position that we took. So now we are left with 2 more lots on the call side, 81,000 C, 1,000 points away, 1,000 points, I would say, because the close of Sensex is at 79,940. That's very near to 80,000. So this 1,000 corresponds to some 1.2 or 1.25% upside. And the reason why we're still holding back to this is there's a good chance that it may still expire within 81,000 C. It's much better than 80,600 C, which is just some 600 points away, 650 points away. And even if there's a gap up opening, we may still have a better chance of making some profit in the 81,000 CE. So what we need to do now is, let's assume that even if there is some kind of an up move, are we okay to exit 81,000 CE with some profit? The average is 42.7. So say, for example, can we exit halfway, somewhere around 22? If we do it, then basically we're getting a profit of 20 points is what we're capturing a premium. 20 into 20 is 400 rupees we're capturing. So it is still okay, a small thing, still okay. There's a possibility that it may actually expire out of the money, in which case we get to keep all the premium entirety of 42. But if you're able to get 50% of it and able to reduce the risk and able to just avoid taking any more further risk, then capturing half of it is not such a bad idea. So that's what we need to be targeting. So what we'll do is we will place a limit order, and let's say it's around 22, and let's place this overnight order. It doesn't allow me to. Okay, yeah, regular I cannot place regular orders, so I'll have to place aftermarket hours order. And there it is. Here is the open order. So net, if you had to summarize this week, so there was a decent profit on Monday, and what other positions we had entered on Tuesday and carried all the way till today, Thursday. There were fluctuations, but because of the inbuilt safety measures we had and the risk management system we had, we were able to first, number one, choose a strike that is very far away, so that even if there's a big move, it is still far away from being in the money, and because of that, the premium hasn't moved so much away from our entry point. And secondly, towards the end of the day, we are ensuring that we're closing trades where we think there's a good chance that it can go against us and the loss can increase much further, right? So we are calling it quits. We have exited the trade at a loss of almost 1,400, but the other profit we have made in the 76,200, that still remains with us, and that compensates for the loss we incurred today intraday in the 80,600 CE strike price. And the other call strike that we held on to earlier, 81,000 CE, this is about 1.2% away, and there's a good chance, I would say 50-50 chance, that even this can be breached tomorrow. We'll have to see, we'll have to look around, and early in the morning tomorrow, based on how the SGX Nifty is trading, we'll get to know what will be the trend tomorrow at the opening. At least, will it be a flat opening, will it be a gap up opening? If the gap up as well, by how many points it will be a gap up? So based on that, we can relook and adjust the order we placed, or AM order that we placed now, to exit the 81,000 CE strike price. And we see that the premium may not be 22 what we are trying to buy. Then it's good that we may have to exit at a higher premium, still at a profit, kind of reduce a profit, maybe around 30-32 for example. So you should be able to exit it based on the calculations of the premium Black-Scholes calculator. So that's all we have for today, Thursday, the 2nd of January. We'll see later tomorrow.